Repo Madness has gone global. So a little over a week ago, the Bank of International Settlements report came out, their quarterly report for December 2019. And I thought they were very candid. It's a 154-page report. You don't have to read the whole thing. The repo section was from pages 21, I think, to 24. Very interesting. And I thought they were being honest because they're trying to give people fair warning. And not only did they talk about the US repo problems, and I thought they were the most honest and detailed out of the repo analysis I've seen so far, but they also talked about looming repo problems in the European Union. And also over the weekend, Doug Noland, who has been in the hedge fund business for 25 years, he writes the Credit Bubble Bulletin, which is a very famous blog. I just reached out to him through emails, and it looks like I'm going to be able to get him on for an interview in the near future. He put out a blog article over the weekend talking about, global macro stuff, how the U.S. is national. It's a very short blog article. It was about Repo Madness, at least a couple of the paragraphs, and you can see them on your screen there. Some of the key paragraphs from the article. So I'm only going to talk about, this is going to be a very short show because it's late at night. I had a bunch of other things I had to do today and I'm feeling better now. So I'll just do a very short show right now. There's a couple short Bloomberg articles about summarizing the Bank of International Settlements report there about the EU repo problems. And they're nowhere near as bad as the US ones, but they are looming on the horizon. And then Doug Nolan's analysis in his blog article I found very interesting. I think some of the stuff in there from Doug Nolan's blog article over the weekend is a must read, and I'll attach links to that in the information and description section. That's also a short read. So the first article, as you can see, you see the Doug Nolan's article, but I have in the title, the thumbnail is Now Repo Distortions Emerge in Europe's $9 trillion Market by Anjali Warachate from December 9th. And the €8 trillion or $9 trillion market is becoming increasingly fragmented, according to the Bank for International Settlements. While this hasn't caused harm yet, it raises the risk that cash may not flow through the system properly, which is what repo experts like Zoltan and others here in the U.S. have talked about with problems in the plumbing. The Bank of International Settlements said in a quarterly review, that's what caused chaos in the U.S. almost 3 months ago. Trading repos repurchase agreements where bonds are used as collateral for short-term loans acts as the essential plumbing for the wider fixed income market. The Federal Reserve was forced to take action to calm the repo market. Massive intervention and new term repos. Just keep on layering the term. What the Fed is doing with the term repos and how the banks have gone from overnight repo to term repos is nuts. To calm the repo market after rates spiked in mid-September, some fear a similar event later this month when year-end liquidity needs renew the pressure. The Bank of International Settlements study found the European repo market has in recent years been driven by investors seeking specific collateral rather than funding. That exacerbates a segmentation along collateral lines where liquidity, price, and behavior of securities all vary by geography, and some traders specialize in bonds issued by their own government. The whole trend has gained strength thanks to central bank stimulus, which simultaneously increased funding liquidity but removed collateral, the Bank of International Settlements said. So in the U.S., I don't know if it increased funding liquidity because of what the Fed did with quantitative tightening and reducing the balance sheet, taking reserves away. So the Fed almost broke things. I don't think the Fed realizes how close they came to breaking everything last year, a year ago, in November of 2018 and December of 2018, when the credit markets froze up. Some of the junk bond, I think the junk bond market froze up for 40 days, something like that, approximately. So the rate hikes, because all these zombie corporations are over borrowing, so interest rate increases are that more onerous. So the junk bond markets and the credit markets froze up back then. The Fed came very close with quantitative tightening and that last rate hike Jerome Powell did last year in December 2018 of almost breaking things. Okay, back to the article. The Bank of International Settlement study found the European repo market has been driven by investors seeking specific collateral rather than fund. Okay, I already read that part. The whole trend has gained strength thanks to central bank stimulus, which simultaneously increased funding liquidity but removed collateral. Okay, I already read that part. This may impede the redistribution of liquidity. Authors Patrick Schaffner, Angelo Rinaldo, and Kostas Satsaronis wrote in the report there are roughly two segments in the repo market: general collateral repo and specific collateral repos. The former is primarily for borrowing and lending of cash, while the latter is driven by collateral needs and transactions specifying particular securities. Within both segments, liquidity in Europe varied according to the home country of the collateral, the Bank of International Settlement said. The most traded specific repo was German. Spanish and Italian collateral segments demonstrated lower and more volatile liquidity on average. Market participants tend to specialize in one or just a few segments, the Bank of International Settlements found, contributing to the fragmentation. The risk is that all, quote, may hinder arbitrage activity across collateral segments, according to the report, or a repo expert in one country does not know the collateral in another. For now, the European Central Bank short-term euro rate, the wholesale euro unsecured overnight borrowing cost for the region's banks, is betraying few signs there might be trouble brewing beneath the surface. That's because the European Central Bank is trying to buy everything. And I even saw Koos Jansen, well, whatever his real name is, Jan Nieuwenhuis, he posted an article, I think it was translated from Dutch, or it was a Dutch newspaper, about how American companies with their European divisions, their European segments, are issuing bonds in Europe, and then the European Central Bank is buying them. As if some of these American companies needed the European Central Bank to buy back their debt. But it's happening, apparently. So for now, the European Central Bank short-term euro rate wholesale unsecured overnight borrowing cost for region's banks is betraying... Okay, I already read that. It remains unclear whether... It is after 1 a.m. It remains unclear whether the importance of collateral demand is reshaping the euro's market dynamics in a permanent shift or only a consequence of the central bank's balance sheet expansion, the Bank of International Settlement said. In either case, these efforts have amplified the trend towards market segmentation. Okay, and this is another article from Benzinga from Amit Nag. Segmentation in 9 trillion Europe's repo market could lead to problems. And this is summarizing the Bank of International Settlements report, too. European repo market is showing signs of fragmentation. We find the market recovers strongly from periods of intense stress, even though it remains segmented according to the home country of the collateral used. According to the Bank of International Settlements report. Why does it matter? The repo market in Europe has recently seen more people interested in trading collateral rather than funding. According to Bloomberg, could cause cash flow problems in the market in the near future. Quote, in recent years, signs of segmentation have increased as the main motivation of repo market participants has shifted from funding to trading of collateral. The repo market typically, okay, it sounds like a lot of this is just a summary of the first article. Finally, to the Doug Nolan article. And I thought this one was really interesting. There were some really interesting parts in here. There's a couple really good paragraphs. You can see them on your screen. So he briefly talks about the amount of the federal government debt in the U.S. expanding, borrowing at a 10.4% pace during the quarter, the strongest since the first quarter of 2018. But let's talk about his analysis here of the repo. Okay, so total repo, federal funds and security repurchase agreements, liabilities jumped another $222 billion during the quarter to $4.502 trillion, the highest going back to the third quarter of 2008. Over the past year, repo surged a record $932 billion, or 26.1%. For perspective, repo liabilities rose on average $51.9 billion annually over the past 5 years. So repo was not a big deal over the past 5 years. From 2014 to 2018, according to Doug Nolan, former hedge fund analyst, hedge fund manager, his analysis. He works now for McIlvany Wealth Management, and he designs their tactical short trading strategy. And the $932 billion gain during the past 4 quarters, wow, that's a big gain, is more than double the biggest annual rise over the past decade. Wow. 2010's $422 billion gain that followed the $1.672 trillion 2-year crisis period contraction. Ominously, the past year's gain also surpasses the previous record 4-quarter gain of $824 billion for the period ended in June 2007. Repo assets, as opposed to liabilities, surged $1.07 trillion over the past 4 quarters to a record $4.813 trillion. This is some more interesting analysis here. Next paragraph. Who holds these trillions of repos? First, it's broker-dealers who lead the way with $1.467 trillion. So these broker-dealers are Bank of New York Mellon, JP Morgan, some of the others. Because they're the middleman, they can mark these things up. They can connect their market makers. They can make a big fees on repo. and I've talked about this with Bank of New York Mellon, how 3 years ago, when they took over the custodian running this private repo, that initially when they took it over, it was around zero. It was not a business. And they grew it in about a 3-year period. They brag about this on their website. They grew it in a 3-year period from almost zero business to $100 billion a month. So they make fees off the $100 billion a month in repos that they do at Bank of New York Mellon. Even though I didn't even know that they were a player in this until I found out on a McElvany weekly commentary a couple months ago. So Bank of New York Mellon is not really known as they're not one of the 4 largest banks, and they're a big repo player. Followed by money market funds so money market funds are heavily involved in repo at 1.173 trillion. The rest of the world, so these are maybe foreign pension funds, insurance companies, 781 billion, foreign banking offices in the US at 403 billion, and the Feds recently acquired 203 billion that's been added to their balance sheet. In extraordinary growth over the past year, quote, repo holdings have increased 302 billion for the broker-dealers. It's massive. 252 billion within money market funds, 145 billion for rest of world, 98 billion at foreign banks in the US, and 203 billion held by the Fed. So that may also be related to the amount of forward dollar swaps, which the Bank of International Settlements talks about in that 4-page section of the repo report from pages 21 to 24, how the amount of forward dollar swaps has exploded in the last 3 or 4 years. Okay, let me read the last couple paragraphs here of the Doug Nolan blog article. So U.S. securities repo finance is clearly a major source of liquidity for the markets as well as the real economy, yet this bubble dynamic is undoubtedly global, with international securities finance instrumental to inflating securities and asset markets around the world. A Bloomberg article this week referenced a 9 trillion European repo market. There are also large repo markets in Japan and throughout Asia. How much finance used to leverage global securities is originating out of the likes of Hong Kong, Singapore, and Shanghai, not to mention the Cayman Islands and Luxembourg. How much global repo finance has been flowing into U.S. debt markets? See, the rest of the world holdings of... Okay, one more paragraph here. Skip that paragraph. This is the last repo one. Notably, rest of world U.S. repo liabilities jumped 292 billion or 43% recently in only 9 months this year to 1.207 trillion. How much of this rest of world market activity, securities buying, and repo finance emanates from global repo and offshore financial centers funding leverage speculation in U.S. securities? Is the Fed really going to expand its balance sheet $500 billion to quell any potential year-end repo market pressure? So I think this has to do with the dollar shortage too, because those forward dollar swaps, there is a lot of them. Remember what I talked about in the last week with what Claudio Borio said in his Bloomberg interview, how in his opinion, his research at the Bank of International Settlements, and I thought he was being honest about this, and people in the gold community and alternative media who want to say that everyone's dumping the dollar are not talking about this, but there's massive demand for dollars because they took with these derivatives, these forward dollar swaps, and now they need dollars to pay those back or they're risking collapsing immediately. RR says he wonders if the Bank of New York Mellon will be the sacrificial lamb like Bear Stearns or Lehman Brothers in 2008. You may be right. They're not a big bank. Wow, that guy was annoying. Okay, so I think that's most of the stuff I wanted to cover. So I think if you look at the Bank of International Settlement repo report, and it's only 4 pages. It's a massive report, but the repo section is only 4 pages. And then you look at the articles that have come out about the European repo market. It's not a danger yet, but most of the repo problems are all dollar liabilities. It's all because of this dollar shortage, because emerging markets and foreign businesses outside the US overborrowed dollars. They were betting on a weak dollar. Now the dollar is getting a little bit weaker. It's been struggling to stay above 97 on the dollar index, but that's still on a relative basis compared to other fiat currencies. It's still a lot stronger than most experts would have expected the dollar to be right now. And I did get an email from Doug Nolan back. So I've been sending out emails to experts like Victor Sperandio and others trying to book more interviews. I have not gotten a lot of emails back yet, unfortunately, but I did get an email back from Doug Nolan. So hopefully I will be able to book him for an interview in the next week or two. Although we do have some holidays coming up, obviously, soon here in the US. So I am working on getting other interview guests back on. It's just been a lot harder lately because I think I sent out like a dozen interview emails in the last week or two, and I think maybe I've gotten 1 or 2 emails back. I don't know why. Maybe it's just the holidays. Or maybe people don't like me now because of my content, and now I'm criticizing people in the gold community and the alternative media for their track records. Because I'm saying that the dollar is not going to collapse immediately. Mike asks a good question. What is the catalyst that takes this whole thing down, in my opinion? There's not one thing, Mike. This is the problem. I've been talking about this now for years. There's a lot of economic landmines. You have corporate bonds in the U.S., which are a major issue. The Fed released in November. Wolf Richter talked about this on a podcast, and I just started doing some research on this last night. There's a financial stability report the Fed released, and they say that one of the biggest risks is the leveraged loan and the corporate bond market. Leveraged loans, the amount of leveraged loans has exploded. I'll talk about this on another show. I don't want to go into too much detail because it's already too late at night. And I probably don't have that many people watching. So, no, the Indian economy is not that large. So the Indian banks have been bailed out a lot in the last 15 or 20 years. There's been a lot of bailouts. So if you want to look up the amount of bailouts, I want to say there's been at least 3 rounds of bailouts for Indian banks in the last 15 years, give or take. So no, in my opinion, the Indian economy is not large enough to take everything down. It would have to be a bunch of emerging markets loans defaulting at once, triggering European banks. So you have the largest problems are China and the Chinese banks. You have Japanese banks. You have emerging market dollar debt. You have European banks. You have corporate bonds in the U.S., and I think the repo market, I think it's based on problems with dollar shortage. Because the Bank of International Settlements talked about these forward dollar swaps, and we know that Chinese banks, according to Kyle Bass and others, have borrowed a ton of forward dollar swaps in the last 3 or 4 years. China is more than big enough. And the European banks have a lot of loans to Chinese banks. There's a lot of loans there in the euro-dollar market, and so there's a number of collapse or trigger points. It's not any one thing. Mike, it's not any one thing. But you have people screaming that like foreigners are going to dump the dollars. It's just ridiculous because if they don't pay back their dollar-denominated debt, they collapse immediately. Look, I respect a lot of the people. There's very smart people in the gold community and alternative media. They're just not doing good research. Because if you have trillions of dollars in dollar-denominated debt outstanding and you don't pay any of the payments now, you collapse immediately. It's that simple. So they have to pay at least the minimum payments on their dollar liabilities back. They need dollars. That's why the dollar is not going to probably collapse immediately, because even though the Trump administration, the Fed, and the Treasury Department all want a weaker dollar, globally there is very strong demand for dollars. Because if you borrowed in dollars, if you have dollar-denominated debt, if you have dollar bonds like all these Chinese companies that are failing now, if you have all these dollar liabilities, you need dollars. So there's 2 countervailing forces, the unstoppable force versus a moving object. The unstoppable force versus the immovable object with the dollar. So you have the U.S. who actually wants a weaker dollar, and you have all these entities who need dollars. And they already borrowed a lot of dollars, but now they have to pay them back. And they were all betting there was going to be a weak dollar. So it's tough to say, Mike, it's probabilities. It's tough to say what collapses first. Japanese banks, Chinese, the Chinese economy, Chinese banks, emerging markets, European banks, U.S. corporate bond market. It's tough to say. There's problems on all of them. And I think what collapses first matters, because then if a country collapses first, they will have less negotiating power at whatever the next global financial system is. They're going to have less negotiating power, like at the potentially the next Bretton Woods or whatever whatever they decide to do to negotiate the next system. That's my opinion. But yeah, the alternative media, the gold community are like, oh, everyone's trying to dump the dollar, and the analysis I see is not reflecting any of that. That's why the dollar hasn't collapsed, because people need the dollars now, because if they don't at least make the minimum payments on their dollar bonds, they collapse immediately. But the U.S. government doesn't want a strong dollar. They want a controlled devaluation. So it's a mess. So it's similar to what Brent Johnson's saying with the dollar milkshake theory. I've interviewed him a number of times in the last year and a half. I agree with him on a good amount of the stuff, not everything, though. He tends to be very bearish on gold in the short term. I'm not sure if he just is hoping to buy more gold if it crashes, but I thought he was expecting gold to go below 1,200, maybe even below 1,000 temporarily, but I disagree with him on that. Because if gold were to go too much lower, I mean, it would bankrupt the miners. I was going to do a show on miners a couple hours ago, but I didn't get home from the gym in time, and I didn't get enough research done, so I'll try to do that show on Tuesday. Well, Tuesday afternoon or evening. There's some interesting stuff going on in the gold mining community. Basically, what my source who was at the Denver Gold Forum told me, a lot of it's playing out now. If you go back and look up that video, Insights from the Denver Gold Forum, that I put out a couple months ago, what I was told by my source who was at the Denver Gold Forum, a lot of the stuff is playing out exactly as the source said. RR, excellent question. Do I think this is just a game of chicken between the leading economies to see who crashes first at this point? Yes, I think no one wants to be the first country to collapse. I don't know if it's a game of chicken. It's what, Survivor? Yeah, I think probably a better analogy would be like Survivor. So they all realize that they could collapse, and they're trying to do whatever they can to be the last person to collapse. That's what I think. The dollar is probably being saved for last as of now. I think I agree with Kyle Bass said that years ago. It was about 4 or 5 years ago Kyle Bass said that the dollar would be saved for last, and I tend to agree with that. If I change my mind on that or I see things change, of course I will let you know. There's a lot of real world data that the global economy is not doing well and the U.S. economy is not doing well. But Jeff Gundlach just did a total 180 and just became positive on the U.S. economy, no recession, or 30% recession down from 60%, which is kind of ridiculous. Bob, the Fed has talked about yield targeting. So they don't want an inverted yield curve, but I don't know, they don't want interest rates rising either. I think they want a fairly flat yield curve or not massive spikes in interest rates. They've talked about yield targeting recently. I did a show on that. Yep, the Plaza Accord. My friend, actually I'm not friends with him, but I've spoken with him in a couple emails, but Daniel Amerman, who's been very quiet for years, he just released a new blog article. It's very interesting. I was reading it earlier today. Well, earlier Monday. and he said that the Fed is monetizing most of the debt. So you may want to take a look at it. Daniel, DanielAmemerman.com. He hasn't written in years. His articles are normally really, really good. He worked as an investment banker and helped design some of the derivatives prior to the 2008 financial crisis. So he was warning people because he made the derivatives, so he knew how bad they were. So now he's been writing a lot of good articles for years, but I think he took a break for a couple years recently. His articles are really good. I used to read them all the time. So, Richard, I do not think that India is a black swan economy. Their economy is not large enough. Now, if them and other emerging markets have all this dollar-denominated debt and they default, the European banks that own that dollar-denominated debt that's being defaulted on by emerging market companies, they're in trouble then too. They're in more trouble. Deutsche Bank says 40 to 50% of the government debt net purchase next year will be buying by the Fed. What do I think? Some of it could be. According to Daniel Amerman, it's more than that already. Daniel Amerman just put out a blog article saying it's 90% now. I didn't look all... I don't remember offhand all the... I don't have the article up. I don't remember all the exact details, but he was saying that the Fed in the last couple months has been monetizing 90% of the debt that the Treasury issues. The math is in the article. The thing is that the interest payments on the national debt are not a massive amount of the US's GDP yet. So relative to Japan and the European Union, the interest payments on the debt, the US has smaller interest payments on the national debt. Lynn Alden on Twitter, she's an up-and-coming analyst. She's pretty good. She was talking about this in the last week or two, how right now the US only pays their interest payments on the national debt are only like 5% of GDP. And if I remember correctly, Japan and the European Union are 40%. Their interest payments on their national debt for Japan and the European Union are 40% of GDP. Yeah, it's a perverse situation with the dollar-denominated debt and the forward dollar swaps, because you have all these emerging market countries and emerging market businesses that took out dollar-denominated debt and gambled on a weak dollar, and the dollar has not gone weak anywhere near the weakness that they expected. So yeah, they'd like to, like the gold community is saying, abandon the dollar, but you know what? If they don't pay that dollar-denominated debt, they collapse now. They collapse a week from now or a month from now. And you're seeing these news stories in China. You're seeing massive defaults in China on dollar bonds. I'm trying to get a story confirmed. I'm not going to talk about it in detail yet, but I was sent a video by a podcast listener in Asia. I think he's a China expat. I'm not sure. I think he used to live in China. And he sent me some video of a large bank run in China. And this is not like one of the smaller banks. This is one of the 4 biggest banks. So I'm trying to get that confirmed now. I won't talk about that story anymore because I don't have confirmation of it. I'm working on getting that confirmed now. If it's true, though, and there was an enormous bank run at one of the branches of one of the largest big 4 banks in China, that would be absolutely enormous news. And it would be amazing how the Chinese state-run media managed to cover it up, because it was that big a bank. But apparently, I've seen the video because I was sent it, but apparently there was thousands of people arrested. So I'm working to get this confirmed, seeing if other people... I know I have a lot of listeners who are China expats here who speak fluent Mandarin, so email me. You know who you are. There's a couple of you. Check Chinese social media. I do have the video. I could probably send you the video and see if you can get it confirmed. If it's true, it's really big news. And it's amazing that the Chinese government and the Chinese state-run media has kept it out of the news. This would be like way bigger than any of the bank failures so far. Like a lot bigger, if it's true. Again, trying to get it confirmed. Okay, so thank you everyone for listening tonight. That's it. I'm going to put links to the Doug Nolan Credit Bubble Bulletin article in the information description section and the 2 Europe repo articles if you want to read more about that. But it sounds like all these repo markets all lent out a lot of dollars, forward dollar swaps, and a lot of that borrowing came here to U.S. markets and U.S. debt markets and also U.S. stocks, according to Doug Nolan. And now there's all these dollar liabilities. This feeds into the dollar shortage. So it's very perverse because you have these foreigners who want to get rid of the dollar, but they were all betting on a weak dollar. So they overborrowed in dollars since the 2008 financial crisis. And for a while, it was working. The dollar was getting weak and it was easier to pay back their dollar denominated debt, but they kept borrowing in dollars, betting on a weaker dollar. And then the dollar didn't keep getting weaker relative to the other fiat currencies. And this is the problem you have. You have massive amounts of dollar-denominated debt outstanding, over $11 trillion, according to the Bank of International Settlements, for non-financial, which is non-bank, dollar-denominated debt outstanding in the rest of the world, outside the U.S. And then also, according to Claudio Burrio, who did the interview with Bloomberg last week, there is even more than that in dollar liabilities, forward dollar swaps, and other dollar-denominated debt off balance sheet. He said it's over $13 trillion. So those entities that have borrowed that much that many dollars, they have to pay back some dollars. They don't have to pay back the whole dollar loan now, but they have to make payments in dollars now. So they have demand for dollars. And if they stop making payments on that, they're going to default right now. And that's what you're seeing in China. You're seeing all these dollar bonds from large Chinese state-owned enterprises, large Chinese corporations. You're seeing defaults now, which is not good. Okay, that's enough for tonight. I want to thank my over 200 Patreon account contributors, my dozen or so monthly PayPal contributors, and people who tip me once in a while. It's much appreciated so I can focus on content, research, and analysis just like this.